Howdy, Jacob here. Today we're looking at BERY Global Group in the containers and packaging industry. Just under 7 billion market cap on over 15 billion enterprise value. So recently I've been looking at some net debt stocks here, founded in 1967. They supply non-woven, flexible, and rigid products globally. Growth is actually fairly impressive, just under 5 billion in 2014 to 12.6 billion in 2023. I presume there might have been some net acquisitions along the way. Return on invested capital, 4 to 5%. Nothing to brag to mama about. They do pay a dollar dividend now. It's about a 1.8% yield. It looks like they can easily afford that based on their earnings per share here. Gross margin is up. Operating margin is up. So there are some positives here. Balance sheet is the negative part here. So 1.2 billion cash on hand with 9 billion in long-term debt. Okay, so 9 billion long-term debt versus less than a billion. I mean, it's about 10 times their 5-year average free cash flow. So you're looking at a plethora of debt here. They went into debt to fund these acquisitions, which did improve quite a bit their earnings power and definitely their revenue. But there gets to a point where you're going to have to balance out growth with not wanting to go under. And so I would say my projections are going to be based on maybe a 40% allocation to debt reduction to limit that debt. It's almost 10 years, pretty much. It's about 10 years of their 5-year extra cash flow, which is it's a huge amount. So I want them to really start focusing on bringing that debt figure down. And then it's just limiting 50% allocation to share repurchases, dividend, acquisitions, reinvestments. That's the tough thing, is that my projections are going to be limited due to the fact that 40% of their money is going to be going towards debt reduction. So on the revenue growth side, I do think pretty much inflation related makes sense. And then I've been starting to base my price to earnings and price free cash flow more on enterprise value. So I think at the end of 7 years, 40% of that cash flow is about, let's say, 400 million. Reducing that 7 years, 2 billion. I mean, you're still looking at a huge difference, huge disparity between market cap and enterprise value. So I think I'd be comfortable with a 10 on the P price free cash flow side at the end of 7 years, due to the fact that they're still going to have a pretty big disparity in enterprise value and market cap. For margins here, maybe let's do 6 and 7 with a share change of 7 billion. 1% of that is about 70 million. Offset that is about 110 million. 2% would be 140, just under 200. I think that should be reasonable. 200 million. And then the dividend, 132. Let's keep that the same. We're at about 300 now. And we're leaving about 15-20% to acquisitions, and I think that makes sense to me. So with my assumptions right here, we're saying the company's stock price needs to fall 33% to get the return we're looking for here. I honestly think that's pretty reasonable. I think that the assumptions are fair. I'm allocating about 40% of money to debt reduction, and then maybe 15% to a dividend, maybe 25% to share purchases, and the rest to acquisitions that make sense, reinvestment to get a 3% return a year on the revenue side in these types of margins. So honestly, not terribly far off, but to me at this price point, I'm just going to be patient and waiting until it gets to one that's more attractive. So hopefully you enjoy the video. I'm very